Good evening, everyone. Thank you for being here. I'm Mike Flood with the CRE Finance Council, and this is one of many in our series of after-work seminars. And I really want to thank Mark Fawer for doing this. Greenspoon Marder is a new member, but Mark is not. And he's tackling a subject tonight that I think is important to both banks and non-banks in checking out what the legislative and regulatory structure is going to look like for construction lending, acquisitions, and developments. And he has a great panel tonight, both CREFC experts and experts in the field. And I think it'll be a really interesting discussion between banks and non-banks. With that, I want to hand it off to Mark. Mark, thanks again for doing this.
My pleasure.
I'm happy to have you here.
My pleasure. Thank you. Okay, so welcome everybody. I want to just introduce our panel for tonight. We have with us Dan Cooperman, Chief Origination Officer at Terra Capital Partners, Francilla LeBlanc, Managing Director at Centennial Bank, and Christina Zausner, who is Senior Director and Head of Industry and Policy Analysis for CREFC. And what I'd like to do first is have each of our panelists just tell you a little bit about themselves and about their respective companies and what they do. So Dan, why don't you go first?
Sure, thanks, Mark. So Terra Capital Partners is a real estate debt provider to the commercial mortgage space, commercial real estate space. We lend nationwide. Historically, we've been a provider of bridge debt, mezzanine, preferred equity. Our portfolio skews more toward that sub-debt, preferred equity, and mezzanine, although we're starting to look into and provide more sort of one-stop shop levered senior positions. We're property type agnostic, location agnostic, and I'd say in the last 12 months, 90% of our business has been in providing mezzanine or preferred equity on ground up construction.
Great, thanks Dan. And Fran?
Yeah. Centennial Property Finance is a national bridge lender. We have three buckets into which we finance. Construction lending is a third of our portfolio. Opportunistic lending, which is financing acquisitions with either light capex or TIs, or as well as heavy TIs and capex. And our third bucket is warehouse financing. The warehouse financing space, we either do repos, trust structures, or just assignments that we take from other lenders. And each of those are about a third of our portfolio. We sort of like the scratch and dent sort of company that structure products that other lenders are not comfortable in structure, and we are very, very highly structured. So anything that other companies are looking at and they're uncomfortable with it, we'll take a look at it, structure it, and get the sort of yield that is reflected in the risks that you're taking for that structure.
Great, thanks. And Christina?
So I'm with Commercial Real Estate Finance Council, and you already know a little bit about us because we're one of the sponsors of this program. And so we do a lot of networking events like this, and we do a lot of education in our role as a trade association. But the part of our business that I get involved in, and I've got a colleague here too, David McCarthy, we both work on the advocacy side. We're a consensus-driven trade association, so we've got banks and we've got non-bank lenders, we've got investors, and we've got folks who provide services to these folks like Greenspoon Marder and other seller servicers. So the consensus part is important to us because we divide ourselves along the lines of forums. We've got non-bank forums, we've got bank forums. And the thing that's different about us than I think other trade associations, if these forums don't agree on a platform, we don't put it forward as a CREFC position. And we'll probably get a little bit deeper into the weeds on some of these issues, and you'll see where some of our members disagree, where some of them agree.
Well, that's a great segue. So there's been a lot of activity and attention, and especially in DC, towards all of the regulations surrounding high volatility commercial real estate loans. And I think to CREFC's credit, they've been instrumental in getting new legislation passed and signed just this past July. So maybe, you could give us a little summary of what was accomplished and yet the work that still needs to be done.
Okay, so at a very high level, the statute clarified and actually diminished the role of the existing rule, which has been in place since 2015. So at the very highest level, the statute closed the circle. It made this circle of loans that would fall into the high volatility commercial real estate bucket smaller. And then it also widened some of the exemptions, in particular the borrower contributed capital exemption, and made that a little bit more flexible so that more loans should be able to come out of the HVCRE bucket through that. So that's the very high level point of view about the statute and how it applies to the existing rule. Digging a little bit deeper in terms of some of the things specifically that it did and didn't do, I think one of the important things is now the 150% risk weight bucket or the higher risk weight bucket no longer automatically applies to owner-occupied properties. And then on the exemption side, there is the ability now to use appraisals for the calculation of equity. And also, in addition, you can take equity and cash flow above 15% out of a deal before it's end. So I think those are pretty much the highlights. We were talking before about some of the things that it doesn't touch upon. I think one of the things that has been of interest in the non-bank world is whether or not the statute made any changes in the regulators' minds, or if the regulators have since, outside of the statute, firmed up their view as to whether or not preferred equity and or mezzanine debt are allowed as equity. So.
Well, that's actually, a topic near and dear to our hearts. Anybody involved in structured finance. And what we see a lot of times is people try to engineer deals to provide for greater amounts of preferred equity at the expense of mezzanine lending. And many mezzanine lenders are agnostic about whether to characterize their financings as mezz loans or preferred equity, which seems to me kind of, which makes sense. What doesn't make sense is why the regulators would care as much, because what is a mezzanine loan it's a loan secured by equity. And so it's not really a loan on the property, it's really a loan to the investors in the property owner. But based upon the loosening up of the regulations that qualify now for the appreciated amount of the property to count towards the 15% equity requirement, have either of you, and I'll let Ann take the question first, have either of you seen any uptick in activity? Has it helped you in any of your deals get a deal done? Any borrowers mention that?
No, I mean, we haven't had any deal that has not been able to get done because of HVCRE. I mean, it's very clear sort of day one, or once we've gotten into our underwriting and we're working with the senior lender, what that equity requirement is. And to your point, we can structure as pref, we can structure as mezz, or in some instances we'll structure as a hybrid of both. But it's never been an impediment to us getting a deal done in the past, and I haven't seen it in the last couple months since the regulations changed.
Oh, that's good. Okay. Yeah. And Fran?
So I think I could say something similar to what Dan said. We haven't seen any uptick in this space since the new regulations have passed, but in the past we've definitely passed up on opportunities, because if you have a borrower that invested $50,000 in a piece of property and now it's worth $5 million, they were not given credit for this, right? So we have passed up opportunities in the past that it came from a bank and went to a private equity shop where we could not do the deal in the past. I think now with the loosening up of the regulation, it's opened up the space more for opportunities for people like my company, rather than we are now competitive compared to a private investor shop that they would have automatically gone to. We now have the opportunity to look at it and be competitive in terms of pricing for this kind of clients.
So so the new law is a great.
It's definitely better
development
for my company.
you.
Definitely.
Okay, glad to hear. Good. Okay, and we'll get back to regulation, but have you seen what changes, Fran, have you seen in the market, both positive and negative, that affect the level of your lending activity?
So we're very rate driven. We are a shop that does very low leverage, high yield deals. We look for the right opportunities for my company. And definitely spread compression is the biggest issue for us right now. You can't compete with somebody who's lending LIBOR plus 2.5. Typically we would do LIBOR plus, north of 5. With spread compressions, it's just nowhere to go. So I think this is the biggest issue for us right now. Obviously, and other regulations to do with political environment and what could potentially happen in the midterm elections. These are also concerning to us, but definitely spread compression is our biggest nightmare to say at this point.
Yeah, no, I see that. And Dan, you and I have been talking about that in the past, that as interest rates have gone up or indexes have gone up, you don't see that correlating increase in what is paid by the borrower as spreads have compressed.
All-in pricing has sort of remained flat because the spreads have compressed at an equal to or sometimes greater amount than the base rate increase.
And so you're seeing that both in terms of the senior loan as well as in the blended rate for the entire debt package, both yours and the senior lenders.
Yeah, less so for us, but if the 2/3 of the capital stack is experiencing that, then obviously it's going to trickle through to us. Mm-hmm. But I mean, we've seen obviously something very similar. We're playing in a lot of the same markets, albeit at a different part of the stack, and the availability of capital and the pricing of that capital for any deal that is approaching or has any level of cash flow today it's kind of mind-boggling.
Yeah.
It's a great time to be a borrower. Mm-hmm. If you've got those assets. On the construction side, there are obviously less players, less people that are as equipped to underwrite and potentially step in if something were to go wrong. So as a firm, we've always, and we've been doing business a long time together, you can attest to this, we've always tried to sort of jump into an area of the market that is the least populated because we can get spread there. And we were doing bridge loans with you guys, 6 years ago before the proliferation of bridge funds, and we were getting paid nicely for it. But about 3 years ago, that compression started, and we started getting into the construction side of the business. And we're seeing compression there as well, although it's not been as extreme as you've seen on anything on the cash flowing side.
Yeah.
So having said that,
Hey, Dan, another thing that I think Christina probably forgot to mention in terms of the new regulation, one thing that's helpful to lenders is the fact that you can reclassify a loan within the term. So if you start off with a loan that was deemed HVCRA, during the lifespan, you can reclassify it, and that's very, very helpful to lenders as well, because you can go into and sort of project within the first year, I expect it to be cash flow in X amount, and therefore I'm willing to take the risk and pay the higher 150 weighted average spread, and then have it reclassified at some point during the term. So that I think is very helpful to lenders as well.
The tough part is you've got these lenders who are coming in and taking assets and refinancing assets at C of O or when they're 90% complete and getting the benefit of the ridiculously cheap pricing. So you don't have the benefit of the time to have that reclassification.
I actually agree. One of the things the trends that we've just noticed happening, there is so much liquidity in the market that even during a construction phase, you will have another lender come in and take you out at 50% completed, which has always been unheard of. So as a lender, your honeymoon phase of having a project completed and saying, you can kind of project your income through the life of the loan, because you definitely knew in the past that it will never take you out until they've at least reached some sort of, 50% occupancy or something. Lenders are actually coming in and take you out. That's how aggressive it is out there now. It's terrible.
So they'll replace you as a construction lender.
Construction lender and take all
Midway.
the risks. I mean, typically another lender would not even touch it and says, I don't want to get near another lender who's in the process and if all the risk, and especially if it's a New York asset that has all the lien law issues and all that, hairy stuff on it, and they will take you out.
And are you doing anything to try to inhibit that with exit fees, or is that not the market?
Yes, we'd rather go to bed with someone we know than deploy the capital somewhere else. So with somebody that we've had repeated business with, we would rather go in, reduce the rate, work with them. But we've seen that becoming more popular now with lenders coming in and taking you out during the construction phase, not even waiting for it to be 90, 100% completed.
Yeah, I mean, you have your minimum return in there, and the borrower just does the math, and they say, "Is it worth me paying this premium to you to, get in at a blended cost of capital that's 300 basis points inside of what I'm currently paying if I know I'm going to have that outstanding for 18 to 24 months before I sell this thing?" And so it's a pretty simple calculus.
And that's one of the things I'm really worried about, having another downturn because of the type of things that I'm actually seeing happening now. And these are things that would, in last few years, would be unheard of. And you're seeing these little sort of things starting to trickle in the market, and you make you wonder, where are we heading to?
So with the loosening, you're alluding to loosening of underwriting standards. Where do you, Fran, start to draw the line? Like, what are your hot buttons? I mean, you want to be competitive. So how do you, what's your competitive advantage, and where do you draw the line?
So if we've seen, there are times when an investor or sponsor come to us with a structure, and we look at it and we say, we will not touch this without being appropriately compensated for the risk of that. And they could come back to us and says, hey, I'm getting out there L+3, and we know that this is a deal that's worth L+5 based on the risk. That's when you start getting concerned about what other lenders are doing to be able to finance this and taking the risk and not getting the reward for that sort of structure.
So when you lose a deal like that, what is a profile of that very aggressive lender that's doing the L+3, that should be really doing it L+5?
Sometimes we're not aware of who the lender is. So it's very difficult to assess that and say, these are the kind of lenders that do that. But, we'd have a potential client come to us and says, I'm getting another lender that could give me LIBOR +3. What are you talking about? And we would not touch this without getting compensated appropriately for the risk that we are taking. We just won't. We'd rather deploy our money somewhere else.
I think that there's, for every deal, there's always going to be, or most of the time, there's going to be a lender or two that wants the deal more than anybody else because they've got, they just had a bunch of repayments and they need to put cash out, or they just started their fund and they've got to get going, or they're short on multifamily and they want to balance out their portfolio, so they'll do a multi-deal. I mean, you saw that in CMBS all the time where people would do loans at, a break even or losses just to help the overall securitization. That's not exactly what we're dealing with here, but I think that there's so much capital and there's so many different providers that are doing all of these things that there's always one or two of them willing to stretch on it. And it makes, sort of sticking to your guns and having some standards a little difficult.
I think the day when you start doing loans because you're desperate for doing them, you're over.
It's true. True.
If you're just doing a loan just because you just need to put the money out there, or you're not doing it for the right reasons, you don't have a long-term plan.
Yeah, that's a very good point.
That's how we think about it.
So Dan, having said that, what geographic markets and what asset types are you looking to do more of that you feel is either underserved or where maybe you have a competitive advantage?
I'd say car washes and tertiary markets. No. So as I say, we've been doing a lot of construction.
I have a mall that you can finance in Des Moines.
Great. We've got some of those that we're looking at. So construction, obviously, I think the profile of our borrower is a middle market borrower, so it's not the behemoths in each market that can rely on B of A or Wells or any of those banks, and are typically much lower leverage borrowers. So we've had a lot of luck in the last 12 months in the Bay Area. We've done a half a dozen deals, all construction, 2 student housing, an office, pre-leased office, a hotel, market rate multi, and it's, I think, a combination of just good coverage that we're getting, the relationships that we have with the senior lender community as well, and the fact that these borrowers, these middle market borrowers, tend to be higher leverage borrowers in today's market, and what that means is more like 75% of cost, right? And so the 75% of cost borrower, 8-10 years ago, that was all first mortgage, right? And so today it's more like 55 to 60% first mortgage and 15% mezz. So we're putting out anywhere from, call it, 10 to 20 million bucks a deal on assets or construction projects that are anywhere from, call it, 40 to 100 million dollars, and we're finding a pretty fertile market for that. And I think once you get deals done with borrowers, they want to amortize the costs of all that expensive, legal work that gets done, and they want to do repeat business with you, both from the senior lender side and from the borrower side. One thing that's really important to us, or becoming more and more important, is of that 25% equity that's going in, you're really paying attention to how much the developer actually has and how much that GP has in the deal. So when we start seeing these, developers got a couple $1 million in a $100 million deal, that gives us a lot of heartburn. I mean, there's equity there's real equity, but it's all LP equity. So we're focusing more and more on that.
And on probably the guarantees and.
Of course, yeah, absolutely. I mean, that's what we were talking about this before. I think on a whole, we've traded up, as we've gotten into the construction business, we've traded up in terms of sponsor profile, and we've traded up in terms of market, as compared to the types of lending we were doing, 4 or 5 years ago. But on the construction side, clearly the underwriting is critical, and we're underwriting larger and larger contingencies these days, given labor shortages, given material costs, given tariffs, et cetera. But you got to pay a lot of attention to that balance sheet and see if that completion guarantee is worth anything. Because ultimately, you don't want to take a project back mid-construction. Right? If you think that this thing can get built and this group has the wherewithal to finish it, and they've got some balance sheet to throw in some additional dollars, you're going to own a building that may be complete but not occupied at our basis at 75 cents on the dollar. We're very comfortable with that.
Are you also looking at the balance sheets of the construction, of the general contractors and the construction managers as well, and see the value of their fixed sum contracts?
You've got to pay attention to all of that, obviously.
Right. And Fran, what about you? What are your what's your sweet spot, or what areas are you looking to invest and finance that you think are maybe underserved that could give you a competitive advantage?
Yeah, so we're definitely not chasing the same sort of deals that everybody in the market is chasing. Again, because of the way our platform is structured, with getting more on the higher yield, we're looking for the quirkiness in the market. So we'll do the ski resorts, we'll do data centers, just the differences, the anomalies within the field, right? I think data centers are becoming a little bit more popular now. But a year ago, we were seeing a lot of that, and now it's a whole bunch of lenders are now gravitating towards it because they realize it's a good space to be in now. But really, we're looking for the sort of like the exceptions. So we'll be happy to look at a ski resort in Utah and do a pre-development loan on it with a ROFR to do construction of it. So these are the sort of deals that can kind of, because of how they're highly structured, will give us the yield that we're looking for. We're definitely not chasing the deals that everybody else is chasing. We are very, very low volume shop, and therefore we are very, very picky about what we do, what we decide to put on our balance sheets. But it's definitely warehouse space, data centers, ski resorts, those sort of deals.
This is sort of like a jump ball question, but there's, because of opportunity zones and the legislation that provides various tax advantages for that, have either of you seen any deals that have come about or become more attractive because of them being in opportunity zones?
Yeah, as a matter of fact, we did something in Denver recently that had quite a bit of tax credits that were given, just because the Denver area is just booming with activities. And this was an old school building that was dilapidated, and the city was really looking for a good investor to come in. It was a 3-year-long project. So the local municipalities did everything they could to pour money into this project to make it work out. And again, this was this was years in the making. So we had that was a great opportunity for Centennial. Very highly structured because you had senior lending in it, which is us. You had mezz, you had tax credits involved, and it's exactly the type of things that we like doing.
And so you had involved in that deal. You had you were the senior. There was a mezz player
And tax credits.
and historic tax credits, or
Historic tax credits. There was bonds involved. There was a lot of money poured in from the municipality to make this work out. It was very important to them.
yeah. Okay, great.
We haven't seen any opportunity zone deals yet. But for us, the underwriting of the real estate and the project are the same, regardless of whether our borrower is sourcing its capital from a bunch of gains from somebody's sale of equities in the stock market or another property for that matter. Mm-hmm. Deal has to make sense.
Right. It's just what their motives are.
Totally.
Irrelevant to you, as long as the value is there, and if it's income producing, if it can cover, and if there's enough of it.
It wouldn't be income producing though, because I think the opportunity zone stuff, there's got to be a construction.
Yeah, there is, or a big
component to it,
rehab.
right?
Yeah.
So it's going to be a heavy lift. There's going to be jobs created as a result of it, which I think is one of the requirements.
Right. And Christina, so in this general rubric of job creation, real estate, financings, whether it's opportunity zone legislation, whether it's EB5, whether it's historic tax credits, what do you see in the horizon, and how is CREFC addressing those opportunities for the industry?
Well, we're monitoring. So just taking the tax piece, we're monitoring the developments on tax and any place where we need to get involved to kind of advocate for a clarification or a change. We get involved there. We're not necessarily drawn into a conversation because jobs are related to it, but since you mentioned jobs, I would say we're doing something that's not necessarily within our usual, kind of monitoring spectrum, and we're watching what's happening with trade. So very different type of a thing, but since you mentioned jobs, that's very much on our minds.
Yeah, very much so. I mean, because
Yeah.
what Dan alluded to before is, the potential impact of tariffs on cost of construction.
Yeah.
And that's a big issue. And how do you deal with that variable? And obviously, you're leaning more on the completion guarantee and on the fixed sum contracts. So, besides monitoring, is there any advocacy that CREFC is doing in that regard?
At the moment, no. But I would add one piece of the puzzle to the monitoring. I think trade, because it is so central to the growth outlook for the U.S. and the globe, it's going to play a role in how the FOMC normalizes rates, right? So it hasn't so far because it hasn't slowed down or necessarily sped up growth. That's sort of happening on its own track, although it seems to the leading indicators related to trade do suggest that going forward it will cause a drag on growth. So it would then go into the FOMC's calculation, and in my view, just one person's view, if you lined up all of the kind of financial and economic types of policies that are out there, probably the one in my mind that has the greatest impact most immediately on commercial real estate lending and other types of lending would be rates, right? So raising and lowering rates. We did a little bit of an impact study a couple of years ago, looking at what the threshold would be for the commercial real estate industry in terms of rate increases. Where would an increase in rates, assuming that spreads followed, right? Assuming that spreads followed, start to have an impact on volume of lending? And we thought it was around the 200 basis point mark. So we're right there if you just look at rate increases over the last 2 years, as opposed, and if you don't even add in the cost of capital coming in through regulatory changes and pressures. So for us, I think probably still the biggest thing that we're watching is monetary policy.
Right. No, I can see that. So the based upon your organization's research, any projections of where that's going, how fast it's going up?
So we're following along with everybody else, but so just reading through and following some of the news from the latest FOMC meeting, I think that a lot of the FOMC members believe that they're nearing normalization, right? So without additional sort of thrusts of inflation, you'll probably see 2 to 3 more rate increases over a period of time, and yet if you start to see major changes in the long-term growth rate due to, let's say, a negative impact from trade negotiations, then you might not see those 2 to 3 rate increases. So I think a lot of it, and this is just based on what the FOMC members have been saying, they've been saying, look at that long-term growth forecast and how that might change. So
is CREFC in favor of, or has it taken a position on the recent trade agreement just reached with Canada and Mexico, and will it be advocating for, ratification by Congress?
we don't get involved in the advocacy around trade, but I think it's with a sigh of relief that there was one.
Of course.
So,
Right. Better than the alternative, right?
better than the alternative at the moment, yeah. But still, the important details are really yet to come.
So, Dan, in a rising rate environment, how do you underwrite for that in terms of what you expect your takeout to be? If it's a condo deal, it affects obviously potentially pricing and the ability of end buyers to pay for their condos. Or if it's just any other type of deal, it could be the takeout of a permanent lender or something else. And how are you factoring that into your underwriting?
Right. So so on a condo deal, just as an example, we will only lend on a condo deal that actually works as a rental. And our takeout of that is going to be, sort of twofold or one of two options, which will be a refi or a sale. And so when we're doing our takeout analysis, we're stressing cash flows and we're stressing interest rates. So we're really trying to make sure that there can be a run up in rates. We take a look at yield curves. We see when this is going to be completed, when it's going to be stabilized, and we try and sort of solve for or size our loan according to that.
Mm-hmm. Makes sense. And Fran, same thing?
Yeah, I think our structure is pretty much the same. I mean, we'll not do a condo without having a rental fallback as part of our analysis. And again, like Dan said, we'd be stressing the rates and seeing where we'd be in the cycle. But it's pretty much the same sort of way we would underwrite our deals as well.
You're seeing, I actually just read this the other day, though, the sort of lower end, which has been the strongest part of the market in New York on the condo side, the sort of, call it $2 million and below, $1 million-ish dollars. It's starting to show some real signs of weakness because rates are higher than they've been, borrowing rates are higher than they've been, and that's a very real input into how much condo somebody can afford, right? So a combination of the tax plan and interest rates moving has really started to hurt that entry level market in New York that has been, throughout all of the negative press about the high end, has been a really steady performer. But that's starting to change.
So in contrast to that, people need a place to live. So if they're not going to buy, does that mean they're going to rent? And has that led to increased strength in the apartment rental market, especially the luxury apartment rental market?
You're not seeing the effects of that lower end part of the market, or at least we're not sort of shifting to the rental. The question, typically that buyer would also be looking in the burbs, right? The burbs are not as attractive as they were, and there was an article a month or so ago about the home sales in Westchester. You can't write off that $40,000 real estate tax bill anymore.
Yeah.
So there's a real sort of shift, and there's a lot of uncertainty surrounding sort of where it makes sense for a lot of folks in that price range to be living these days.
Hey, Mark, just to add to that, we are seeing a lot of cracks in the Brooklyn area when it comes to high-end condos. So a lot of the inventory for lower-end pricing is still going, but the higher-end stuff is definitely, we're concerned about that. So if you have on your book still projects that are undergoing the construction phase and they're on the higher end, we're very, very concerned about that.
So all of this means that there could be, especially in the residential area, a correction in all across the board, the value of land, which is always like a leading indicator of value of future real estate values. Would you say that that's the case, and are there any factors that could offset any of this?
Could offset what specifically?
The rising interest rates. Are there other,
I mean, everything's
demand drivers?
Everything's going to clear at a level. It's just a question of, the sponsor's willingness to lower prices, given that, the last 20 units are where their profit is. And if they drop by $200 a square foot, they're going to make nothing. So some people just say, you know what, I've been to this before. I want to get out of this thing. If I don't make any money, it's not the end of the world for me. Then you have all of these condo inventory lenders who are willing to lend them the capital to sort of see if they can ride this out for the next 12 months and see if the market returns a little bit. But it's just, any broker that you talk to will say, price it appropriately and it'll clear, right? I mean, this is with the exception of a lot of the high-end stuff, because I don't know that there's an actual appropriate level for some of that. But for stuff that's in that, call it $1 to $3 million, you got to look at what the comps are, and you got to price it, sort of 10% below if you want to clear.
Got it. Mm-hmm.
Yeah. Makes sense.
Christina, what about EB5? What's happening, either legislatively or in the regulatory sphere, about the EB5 program? I know there were changes enacted, I think, last year maybe in the renewal, and what do you see the impact of that?
We haven't, to be honest, we haven't been advocating on that, but we're assuming that it's going to be reauthorized. So it is up for reauthorization this year, I believe. Is that not true? Mm-hmm. I think that
so, yeah.
I think that it's sort of hanging in the balance right now, along with the National Flood Insurance Program. There's some big things that we're expecting will be reauthorized this year, one way or another, but that haven't yet seen that happen. So I think the major thing that I've been hearing on EB5 is whether or not you're going to still be able to count everybody in a family as one visa, or if each individual in a family is going to be a separate visa. And so if you have a quota, right, then it's going to make it much harder to actually, much more expensive for a family to move over. Mm-hmm. So that might be one of the ways that the people who are skeptical of these kind of programs get comfortable with it, is to reduce the kind of number of people who can come in through them.
So, have any of your deals, Fran, in the last year or longer, had an EB5 component to it?
Yeah, definitely. We've done in the past quite a number of these. We recently turned down an EB5 project. It was a construction loan hotel financing. We were just not comfortable with the fact that they were taking the number of time, the amount of time frame that they had to raise the money. And again, it possibly because there are changes in regulatory requirements. The goal was to raise X amount of EB5 within a 12-month span. They were like at 18 months, and we were just not comfortable with how aggressive they were in collecting those. We also had an issue with they were structuring in a way where the EB5 was taking a subordinate financing position collectively, and we just couldn't see a clear path as to if there was a default scenario, how we would be as senior lender being able to. We needed to be at the court by ourselves and not trying to negotiate with a subordinate lender who is EB5, and it's an extremely complex process, and for that reason we're just not comfortable.
And what and who
doing
are
the
you
financing.
getting?
Yeah, and the person that's representing the EB5 investors is the regional center, and what do they know about?
Yeah, it just
Right.
it just
Good
becomes
point.
too complex.
Right.
It just was a nightmare scenario.
Not
We
enough
couldn't see
time
a
in the
clear
day.
path in it, so we
Right.
decided to decline it.
Yeah.
But we've done a couple of those, particularly in the Houston area, that were very successful, completed on time. Everything worked out perfectly.
Sure. I mean, it was figured prominently into Hudson Yards project, Jersey City, but just anecdotally, I'm seeing less of that, in my practice.
We
less
are definitely
involvement.
seeing less of projects with EB5 financing in the last, I think, year or so.
Yeah, and Dan, I think
We've
it's your
never-
experience
we've
too, right?
never-
You
yeah,
haven't.
We've never done a deal, not because we wouldn't, not because we have a policy against it, but
Right.
we've never seen one that made sense to us.
In one sector we haven't talked about is hospitality, and I know Tara, you has been pretty active in hospitality financing and particularly in hospitality construction financing. What trends are you seeing there that is that a bright spot, or you really have to pick and choose your market?
Well, yeah, I mean, I think with anything you do in hospitality in particular, it's your market and your borrower, the operator, the flag, the generation of whatever the brand. Obviously, there's a movement sort of towards smaller rooms and more communal space and the programming of that communal space. And so you really want to be looking at flags that are paying attention to that and are doing just that. So that's important to us, and you want to be, in areas with multiple demand drivers. I mean, it's still basic sort of real estate fundamental investing. We like the hospitality space in some regards for the reasons I touched on before, which is a lot of people just won't do it, right? And so there's an opportunity for us to get what we think are pretty good risk-adjusted returns. We underwrite and have an additional sort of layer of underwriting that we do on hospitality assets, where we bring in a hotel consultant and really make sure that we understand the operation and the sponsor's ability to execute on that plan. So the construction of it itself is no different than underwriting, the construction of another asset type. It's it's ultimately the operation side of the business, and that comes down to sponsorship.
And you did a deal recently where there was modular construction that accelerated the time period within which the hotel could actually get built and up and running, de-risking, that aspect of the deal. Is that something that you see a trend, or that could be a trend?
We're seeing a lot more modular, and really the cost savings is purely time, right? It's not that the actual hard costs are any different. It's just that they can construct this a bit more quickly. The issue that you run into is if you get a bunch of panels that are delivered to the site and one of them's off by 3 inches and they all stack on top of each other, then there's a real domino effect there. So we did a deal recently where we really had to better understand exactly how that process works at the factory. And panel A is built, panel B is built, and not until panel A and B fit together will panel A be shipped, and then panel C is built, and once panel C and B fit together, then panel B can leave. So there's a logistics component to how this is done, and the factory and the contractor's knowledge of how that ultimately works on site are critical.
Interesting. Fran, have you financed any modular deals?
We don't like, Dan, unfortunately, we just don't like hotels.
The less people that like it, the better for us. Right?
I mean, if there is a compelling story, good
Right.
sponsorship, good flag, good market, I mean, we'll do those with a sponsor that we know. Typically, if we are going to do hospitality, it would probably be in sort of like a line that has other assets in there, and we'll say, okay, only X percentage of that portfolio can be hospitality, but generally we kind of stay away from it.
I see. But what about modular construction in non-hospitality deals? Have you experienced anything in that
We haven't
regard?
done any of those, no.
No? Okay. So, at this point, I think what we're going to do is open up to questions and answers from our audience. Just raise your hand and let me know who you would like to, to answer that question, or if you want to have it as a free-for-all.
And how do you know, do you compare that to Fannie or Freddie program, construction loan, Gini program, or or how do you come up with your coupon payment, things like that?
Okay, I don't know if you heard the question, but the question is pricing. How do you formulate your pricing? What are the factors that go into the pricing? What's your process? And I guess it's a question for both Fran and Dan. And so, Fran, why don't you take it first, and then Dan can answer.
I'm not sure if we can comment on the comparison to Fannie and Freddie, but definitely I think every deal is different. It's looked at based on risk. I mean, no two deals are the same. If you have a really good sponsor, you have some sort of cash flows coming in, that will be priced differently. If you have no cash coming in, that's going to be, it's really just individual and based on the risk of the asset. That's the only way we look at the assets and determine what the appropriate pricing is for that asset.
Yeah, I mean, that's how we look at it as well. I mean, we've got a minimum cost of capital, so we're never going to lend below that rate. Deals that justify being at that rate are going to have more borrower equity, are going to have, better coverage, are going to have all the hallmarks of just a better credit for us. And deals that start to push up in leverage or perhaps have some sort of sponsorship issue, if that's something that we're comfortable with, then you can get some additional pricing for that. But it's art as much as it is science.
Yeah.
For us, anyway.
Yeah, and if you add some other credit enhancements, that could make a difference. But it's all just really, like Dan said, it's so individual based on the asset type, based on just the sponsors, the risk that you're taking. It's all just built into it.
Okay, good. Anybody else?
Fran, you had said earlier in your comments that there are things, and forgive me if I get this wrong, that you're seeing that concern you for the next downturn. Are there any of those that you can specifically comment on?
I mean, one of the things that I said before about the takeout financing during a construction phase, that is so unusual. It's something that I have never seen. Usually, a lender goes into a project, it's a 2-year term with another 1-year extension. You're hoping to have it on your books and sort of have that honeymoon period between completion and stabilization, where you're actually reaping the benefits of all your hard work, and that's not happening. You can't, and so I'm not sure if everybody shares my view, but definitely I'm concerned that there are people out there that are so desperate to get funds, liquidity out, that they would literally do just about anything to get a deal, and that's what my concern is. To me, that's pretty much what you'd seen prior to 2008, 2009 happening. Not in the exact same thing, but it's the amount of liquidity in the market that people are just willing to do just about anything. I'm just a little bit concerned about that.
Yeah, I think people are sort of underwriting to perfection, and that's never a good place to be in our experience.
Yeah, and again, I mean, obviously, the real estate is also cyclical. We've had 10 years of really a growth period. I'm not the one to predict. I don't have a crystal ball, but eventually I just think of the next phase with the market. I mean, everyone should always be thinking about that.
At the same time, I do think that, today as compared to 10 years ago, you've got much less leverage in the system. There's a lot of liquidity, but you don't have the high LTC or as high LTC as you once did see. You don't have a ton of speculative construction. So I think there are some pretty big components that have been kept relatively in check that while won't prevent us from having a correction, I don't think it'll be the likes of which we've seen in the past, or at least the most recent one.
Please.
I'm sorry, it's probably a bit technical question, but I'll still try. So we recently were looking at a situation where the asset is existing operating, but the client has a big redevelopment plan which they intend to implement through equity. So we are financing, say, like 85% of as-is value, and the client will invest another 300 million to redevelop the asset. We were looking at HVCRE rules, and it seems that the upfront equity requirement is calculated based on as complete, but the upfront equity contribution is calculated on as is, regardless of whether the lender is contributing to that development or not. Or did we?
Well, that has actually recently changed. So yes, it's the calculation is based upon as complete value. So if it's you're building a condominium, they'll probably look at the total projected sellout price. If you're building, it as a rental, it's the capitalized value of the projected NOI on stabilization. But as a result of this most recent legislation, they will count the appraised value of the land fully towards the equity in the project, as opposed to the land basis, which existed. That situation existed pre-July of this year, before the new legislation was passed. So I don't know if that answers your question at all.
I more was talking about situations when you already have an existing building, and it has a value, and you land against that value, but regardless of, and you don't plan to fund anything else apart from that, but the client intends to spend more money, and then their business plan is to have a fully redeveloped building, whatever, which will have twice as much of a value. But do you have to, for the purposes of HVCRE, take into account that future value if the loan is really against the existing building?
So I'm gonna call a lifeline. And
Let's call it,
David, on our call today, it sounded like folks were agreeing that they were using as completed. Is that what you got out of it too?
So the as completed is for the borrower contributed capital. So that's your denominator in that 15%.
Yeah.
But there could be some exceptions where you use an as is, but it's really for vacant land. But if you want to get that exemption through the 15% contributed capital, it would be an as completed. I don't know if they could be considered kind of compliant and kind of keep it as a value that's not developed. But there might be other ways.
But is all the money for the redevelopment coming from equity? Did I hear you say that correctly?
Yeah, but in the future, so they're putting it up.
Right. So I would, and we're not regulated, so I have absolutely no idea.
Yeah, I'm just curious.
But I would think there'd have to be, you do it sort of on a as-is basis, as long as you conform, since you're not funding up eventually, and they're just putting more equity in. I can't imagine why that would get tripped up with HVCRE, given how much equity it sounds like is ultimately going in.
They're not going to count it until it's contributed. And a lot of times what I've seen is that lenders will condition future advances, sometimes if there's like a resizing of the loan, upon meeting that 15% test at that time. You were going to say, I think.
No, I'm good. I don't think you have an issue. It just seems like if it's coming all from equity, then it shouldn't be an issue.
Right. Okay.
Okay, and the gentleman in the back.
Yeah, in the discussion earlier about interest rate or rising environment, you talked about how that might affect your underwriting. You didn't mention purchasing or requiring the borrower to purchase some kind of interest rate hedge product like a cap, which even in a increasing environment, that seems to me really typical for construction lending. So
We require it. And we, as the typical mezz provider, require it of the senior loan, even if the senior lender doesn't require it themselves.
And we are also requiring it more so now than we used to in the past. So before it was basically if you wanted to, as a borrower, obtain it, it's fine, and we'll take an assignment of that. Right now, we are demanding that our clients also have some sort of hedging product.
I had a question for Christina myself. Debt on debt lending. Do they require that when the borrower is itself a lender, getting a loan from another lender that's going to put a lien on that loan, do they still require, they look at the underlying nature of the loan that's being pledged? And if it is an acquisition, development, or construction loan, do they require that 15% threshold to have been satisfied at the underlying level?
That's a good question. Okay, so if I,
Who's the borrower, really?
yeah.
Is
that
it
would be
is it the
helpful.
lender that's borrowing the money to make the entire loan to the developer, or is it the developer whose equity that you're looking at? Because the borrower in this instance would be, let's say Fran, I provide a quote to a borrower for 75% of costs, and I go to Fran and she finances 2/3 of my 75%. I'm her borrower, and I'm putting in a lot of equity.
Yeah, we don't, I mean, we do a lot of loan on loans as well. We typically do not look for that requirement. It's the lender of record responsibility to make sure
So if I'm not regulated, then it doesn't matter.
Yes, so it's your obligation to make sure that you have checked the box. But as a lender of a lender, we don't require, we don't look to see whether you've met the requirements.
Very,
I'm not sure if it's right or wrong. I'm just saying that that's what we do.
yes, yes.
And
Right.
and I would say just a pivot on that theme maybe is that, and again, this is a place where the statute may not have clarified every case, right? But I think what we're hearing from people who are starting to share what they're doing with us or what they're thinking about with us, right? Because that's where we are. We don't know what all the lenders and what all the lawyers are thinking and doing right now. We just get pieces of it. But so I think we're starting to hear people leaning towards the idea that if there's a good theory behind it, yeah, go ahead and ask for forgiveness later.
For forgiveness, not permission.
There's no regulators in the room, right?
This isn't being recorded. Well, it is.
Don't get any ideas.
Okay. Any other questions? Okay, so we'll wrap it up. Thank you very much, everyone, and thank you very much to our panel. We look forward to seeing you at the next after-work seminar and, of course, at CREFC's annual conference in South Beach, which is in mid-January. What is it, January?
I think it's the 11th.
The
It's a little
11th
bit
goes
later
to
this
the
year.
13th, right? It's
Yeah.
always a great event. I like giving a plug for it.
Thank
So
you.
anyway, thank
Yeah.
you very much, everyone.